चलो ऑन है क्या कुछ ऑन है क्या बंद करके ऑन कर लो ऑडियो को इसमें ऑन है ऑफ कर दो
I hope this I'm audible to you everyone.
वो के पास आएगा एक्सेस है ना भाई
Shall we start?
इसका
Shall we start?
इसका है ना
दो बार देती है।
वो दूसरा
हाँ, एक फ्लो वापस हो जाता है। ये देख, ये ब्राउजर से भी ज्वाइन है, उधर से भी ज्वाइन, दो बार ज्वाइन किया।
Thank you to all the participants. We are just waiting for few more participants to join. The webinar will start in 2 minutes. Thank you.
I hope I am audible now to everyone.
Yes, Akash, you can start.
So, good morning, everyone. I am Akash, and I welcome you all for today's investor awareness webinar on asset allocation. So, quickly, I will just share my screen so that you can see the presentation which I have. Rohan, if you can allow me to share the presentation or my screen.
Yes, I have given you the right.
Hope the screen is visible now to everyone. So for the next 30 minutes or so, we will try to talk about the asset allocation. So basically covering what is asset allocation, why it is important, and how it really helps in the investment journey of an investor. So talking about asset allocation, so primarily uh, it, it tells us how during the tough times or during the market cycles, basically how it helps an investor in his investment journey to maintain the course of being invested, and to not panic or not to struggle when there is negative sentiment or there is some market correction happening in the market. It really helps an investor to maintain a balance between his portfolio risk, portfolio returns which is expected, and the current market risk which is pertaining to the portfolio. So so there are so generally when we talk about the risk, and it is basically the uncontrollability or uncertainty which the market provides, which often becomes unpredictable. So just taking an analogy of rain, we cannot forecast rain, and we cannot forecast or judge what time today it will rain, and how much the quantum would be. So primarily, as the market also reflects the same thing, we cannot predict when the market is going to correct and how much the quantum of correction would be. For example, you can look at the right side of the screen chart, which is Nifty 50 index. In the last 13 years, on a one-day basis, how much the market has given on a one-day basis. So the maximum returns which you can, which in the historically it has got is 9%, whereas the downfall has been 13%. Now, when you compare it with with the bond index, it significantly drops even the returns and the negative return on a daily basis. And so this is the single day highest movement in an index, equity or the bond. So you can clearly see the difference of the different asset classes behave differently in the same cycles. Where we see equity is typically on the relative terms, it generates higher return, whereas with a high volatility and you must observe the risk appetite to pertain to sail through those cycles. Whereas when you compare the debt is often considered on the relative terms to generate lower returns, but with a little smaller volatility and much lower risk appetite, with much lower risk appetite. And equity on the longer duration, it is more suitable and attractive for if you stay invested for a longer period. Whereas debt, it it helps to mitigate the risk volatility in the market. Also, it helps you in a shorter duration goals to achieve your shorter duration goals, and also as well as the longer term goals. Now, see, as we saw the different behavior during the same market cycle of these two different asset classes, we understand that both are important, and how do you actually diversify your portfolio is really becomes important, where you can keep stocks, bonds, like equity, fixed income, which is debt, and cash in your portfolio. It really helps in mitigating the uncertainty, but at the same time, also diversify the portfolio and helps an investor to stay invested for a longer duration time, because it inbuilds a sense of discipline for an investor. What happens basically when there is a upcycle and there is a lot of massive rally in the equity markets, a lot of new investors comes in and joins the rally. But what happens when the cycles goes turns negative or downwards or there is some time correction happening in the market? Most of the new investors, they don't uh, want to look at their portfolio in the negatives and often get fearful when the market behaves differently. So for an investor who is new or not very keen to see the portfolio, his her portfolio in the negatives, asset allocation helps them to give the balance to their portfolio, still achieve their goals, which they are looking at, with the stability in their portfolio. So, given an example of how different asset classes or the mix has done in the past 13 years. So this is the same chart which we have seen earlier, where there was Nifty 50 on a single day basis giving highest return of 9%, whereas negative is minus 13%. Similarly, the left side of the chart shows Brazil Composite Bond Index, where the one-day movement has been plus minus 2 to 3%. Now, if you look at the mid path, which is the hybrid, the mix of 35, 65 aggressive index, it shows the drawdown, the drop in the the highest one-day return. Also, at the same time, the downfall of the one single day has been reduced from 13 to 8%, minus 8%. So it tells us how uh, if one investor chooses only equity, there could be higher returns, of course, but at the same time, you can see a drawdown on a one-day basis, which often creates a sense of fear in the investors, where they see a lot of big movement in a one-day basis, whereas the debt index a bit of slow in the daily movement, daily on the basis of daily movement, but a balance of both can fix the issue of volatility and the stability it can provide to the portfolio. So as we discussed the risk, these are the risk basically which an investor comes across uh, to through the investment journey, starting from business selection, inflation, liquidity, interest rate, volatility. So, what is business selection? Business selection is basically the investment, the amount you invested in one company or the fund or the stock or any asset class you selected. That can of course that can also go wrong, right? So that's one risk. The another is inflation. Inflation is basically your 100 rupees of worth, 100 rupees money, which can buy what it can buy in 2003 or 2005. It cannot buy the same worth of good in 2025, right? So it is impacting the worthiness of the money which you have. If the inflation increases day by day, the same 100 rupees won't be worth the same in next 10 or 5 years. So in a way, the if your portfolio is not generating enough, which is suppose inflation stays for 405% approximately for the next couple of years, the portfolio is not earning, and you have invested 100% in the debt, and it is not earning up to the mark. How it will impact the portfolio is it will decrease the it will you will or you will not be even to even be not being able to beat the market, which is on an inflation adjusted market. So it will deteriorate, the portfolio will deteriorate in the sense. The third one is liquidity, where uh, there is not enough liquidity or opportunity to invest, or the if you invest in a market and there is a lock-in or something, and you are not being able to take out your money at the time when you need it. So that's another one kind of risk. Another interest rate cycle moves goes up and down, and so these are the basically types of risk. And the volatility, of course, what we have discussed in the previous slides, that volatility often tends to impact the portfolio on a daily basis, and that is measured by standard deviation. So to understand standard deviation, which is a measure of risk, this is a perfect example which you can see on the yearly basis from 2001 to 2010, in the month of July, what has been the average rain in the month of July. So in 2001, you see 281 mm of water rainfall, whereas in 2010 it is 300 approximately mm of rainfall, whereas the average rainfall is coming at 272 mm. whereas it says that the average rainfall every year in July month has been 272, but the deviation is of 52 mm, which says in 2002 the rainfall was even 1 till 144, and in 2005 it goes maximum to 334. So it tells us even the picture looks very good that 272 is a mid path, but it can be deceptive because uh, does not reflect the true picture of how much the deviation is from one average point. It can go either way, very high or very low. So so the so this is the risk of deviation from the average is called standard deviation. Now this will try to understand in terms of portfolio how it reflects. Now, looking at the 3-year rolling returns of Nifty 50 index, which is in the blue, sorry, and the orange one is CRISIL Hybrid Aggressive Index, which is a mix of equity and debt. Now you see the maximum average on a 3-year rolling return basis. The average return for the Nifty index, which is equity, is 12%, where with a standard deviation of 5.2%. So, and the hybrid index has given approximately similar returns, which is 11.66%, with a much smaller or lower standard deviation. So the deviation from the median of the returns has the volatility from the median to the average has been very minimal. So it's 4.1%, generating 11.66% return, and the volatility of 5.2%, generating 12.11% of returns. So this says how a mix of equity and debt can really reduce the volatility in the performance with minimal, slightly lower return expectation from as compared to the equity, completely 100% equity portfolio. This slide will particularly show us that how equity portfolio. So you see this bell curve, bell uh, bell style curve for equity and the hybrid asset classes shows the equity has been a higher return. So the blue uh, bell curve shows the maximum return. So on an average 11.66% returns. The composite index, the hybrid index, has given a 43% of the times the returns have been between 11 to 15%, whereas the Nifty 50, which is equity index, has given 30%, 31% of the times has given a return between the 11 to 15%. It says the consolidation of the return has been very positive or very balanced in when it comes to the hybrid uh, classes, whereas you see the negative returns only there is 0% of negative returns in term when it comes to the hybrid index, whereas there has been 1% of negative returns on a 3-year rolling return basis. So what it does is it's consolidate and balance out the return on a 3-year basis for a portfolio which is mix of both the assets, equity and debt. It helps you consolidate and keep your return in a range bound where your negatives are adjusted and you still get a very balanced and strong steady returns over the years. So it can be taken as the analogy of cooking, where too much of equity can really uh, increase the risk, which is take an example of salt, adding more salt, too much of salt, it will definitely increase uh, the risk of the food tasting bad. But at the same time, too less of salt, obviously, it will decay down the taste, which is the amount of returns which you can expect goes very low. Now, how to decide how much you can allocate and how much you should allocate? That really depends upon the person to person, because that matters on the risk appetite basis of an individual, where how much of risk he or she can tolerate in their portfolio, and what is the return expectation based on their goals, their investment style. Now, if you look at the first two columns of this table, the credit composite bond index, whereas the first column is about how much of the percentage you are allocating to the bond, right? Starting from 0 to 100. Now, again, how much you are allocating to the Nifty 50 in the second column, 100 to 0. So, if you consider 100% of allocation in the equity index, it would generate an average of 12% on a rolling return basis, with a minimum taking a toll of 4.7% of return, right? So even if you consider the 3 year of investment, it can generate an average of 12% with a minimum return of that the portfolio can go till minus approximately 5%. Whereas if you invest 100% in a composite or debt index, the returns get much lower, from 12.1 to 8.5, whereas the minimum from 4.7 minus 4.7, which is 5%, goes to no negative returns, only positive returns of 5% on a rolling return basis. Now, you can say, I'm not expecting a negative returns on my portfolio of, say, uh, I don't want any negative returns in the portfolio in the 3 year rolling return basis. So what you can choose is 40% equity, 60% equity, and 40% debt. Similarly, if you want to maximize the return with the minimal uh, negativity or minimal standard deviation, that is volatility, you can often look at 25 to 75, 28% debt to 72%. So these are the mixes of asset classes, how much exposure you want to take based on what is the return expectation you have, and how much toll you can take on your portfolio on a risk basis, or a minimum returns what you can see at the portfolio at given point of time on 3 year basis. So as we saw in the previous slide, that taking too much of liquidity, too much of equity in the portfolio also poses some risk on your portfolio, that it can go negative at certain times. It can go even lower beyond your expectation, but at the same time, like taking too little of risk, you have to take a toll on the returns expectation. So the ideal condition would be the right mix of the portfolio as of asset exposures, what you based on your risk return expectation and the risk appetite. So given these are the calendar year asset classes returns, where you see the right the each of these index, where there's one bond index, there's one equity index, and this is the hybrid index in the blue, where all these asset classes behave differently in the same during the same calendar year period. So for example, 2010, just after the 2008 crisis, how it has moved vis-a-vis how the credit, if you look at the equity movement, how while it can go either very high or very low, but at the same time, the hybrid, the mix of debt and equity poses some stability in the portfolio on each year calendar year basis. So it provides capital appreciation, of course, but at the same time, it reduces the volatility in the portfolio, which provides stability throughout your investment journey. So as we say, don't put all your eggs in one basket. It often it often means that looking at one big rally coming in equity doesn't mean you have to 100% allocate all your income in one equity portion or one asset class in for your investment, for your savings, but to look at in a very balanced approach, very selective. How a balanced fund or a hybrid fund helps is it manages the asset allocation very dynamically based on the current market scenario, where it turns the market uncertainty into market opportunity for an investor. So quickly, if we can take questions, or whatever doubt you have regarding asset allocation and the methodology, we can take that. Any questions on any of the slides or any uh, confusion over the asset allocation as a basics of introduction to the asset allocation in an investment journey? We can take questions. So there's one question has come up. Does it stand to reason that aggressive hybrid, which has 35, 65, 35 ratio for bar ratio for better than BAA funds balance advantage, you mean? So it depends. So basically, if you balance advantage are mostly in most of the cases, it is dynamically adjusted. So given the market opportunity, as per the so since it would be, I would consider taking an example, it would be an active scheme where uh, it would be on the fund manager or the fund management team to decide what is the right mix at given situation or given market condition. A fund manager can take a call to whether to increase the equity or decrease the equity exposure. He wants stability in the portfolio given the time or given the situation, he can take that. Similarly, when there is some positive movement in the market, he or she or the fund management team can really increase their equity exposure to take the benefit or to take the benefit of the momentum. So that helps the fund investor to generate to get better returns at times. Whereas when you talk about 65-35 fixed aggressive hybrid funds, where if it is in case it is the exposure is completely fixed of 65-35, it can often uh, it may or may not uh, result the same returns or same stability it can provide, because there is some uh, advantage to the fund of being having a fund management uh, in your in your portfolio, which helps you to navigate the difficult situation, navigate the volatile situation. Uh, it helps the portfolio as well. Any further questions we can take? So, so there's if there's no further, okay, there's one question. Historically, returns of aggressive funds across all the frames are high, always better than the balance advantage funds. See, if you have to look, so aggressive funds and the balance advantage fund both. So the asset allocation varies in an aggressive. Of course, the aggressive has always 65. Considering the 65, the fund always keeps 65% allocation in an equity portion. Of course, and the balance advantage fund moves uh, between some ranges to dynamically uh, adjust the exposure in both the asset classes at given situation. Of course, the equity portion would might yield better returns, but at the same time, you have to look at the risk adjusted return they have generated for a portfolio based on how much volatility there has been in the portfolio, and basis the how much volatility there's what is the added returns they have generated. So basis that, you would see, of course, that also depends on how much time frame, what is the have the timing been right, but that totally depends upon the active asset allocation by the fund management team, which they have better understanding of the market cycles given the current scenario, what is going on, and how much uh, uh, they are willing to take a risk and how much return they are trying to generate, and what is the expectation you are having. So based on volatility and the risk, how much added returns that scheme has generated, based on that, it varies. So hope I have answered you. And if there are no further questions, we can conclude this. Okay, there's one follow-up, I guess. Yeah, sure. Thank you. Thank you for the question. So if there are no further questions, we will conclude by saying an asset allocation really helps in stabilizing the returns, stabilizing the volatility of the fund or your portfolio, which helps the investor to be stable, be invested, uh, even during the bad times or the bad phase of the market where one market is not performing. Because see, all the asset classes behave differently at the same point of time, where one year you will see the equity has not done well, where debt has some provided some stability or some returns. So commodity has performed differently in the at the same time. So a mix of all these assets in a right proportion helps you to uh, helps your portfolio to grow and mitigate the the daily volatility in the market, and keeps an investor very steady and balanced in a way. And so that's the advantage of asset allocation. And the right mix always depends upon the what is the investor's uh, risk returns expectation, what is their risk appetite. To understand that, always consider talking to your financial advisor to help you understand what is the right mix and for your portfolio and your based on your expectation and risk appetite. So thank you all for joining the today's webinar, and we appreciate your participation. Thank you.